right. We are live now. This is, again, DePIN Masterminds. This is a subset of that group. Oh, I got some audio going on a different screen now. Let me see if I can go figure out which channel that's streaming on, because I got so many browsers open. Let's close everything else down, shall we? Close down that browser. There we go. All right. So I got myself, and I got Brandon Baker with me from Conduit Network, and I'm from Tashi Protocol. We call this DePIN Masterminds. This is kind of a collective that's organically developed amongst a number of DePIN projects. And Brandon was so nice to join with me today. And we're just going to we wanted to keep this one a little bit more focused on the business and economics of DePIN. And so I wanted to make sure that Brandon had plenty of time to talk about his thoughts and for me to contribute and for us to challenge each other in this discussion. I think that's what's the most important part of this collective, is really us being able to challenge each other. And we each have, we come with our different backgrounds. We've got different business experiences, different startups we've done, different positions in different businesses. And so we have this wide spectrum of experience when it comes to running businesses. And I think, at least for Brandon and myself, we've come to this alignment and understanding of like where this DePIN space could go and a lot of the benefits of this Web3 architecture, you can call it, both social and technical architecture. And we're going to talk a lot about something called alignment, and alignment from both the economic perspective, but also alignment from a business values perspective and a technology perspective. So all of these things are kind of coming together as we go through these things. So anyway, Brandon, if you want to just do a quick intro for anybody who doesn't know about Conduit, just do a real quick intro on that. I know we do it every time we get on this thing, but we can be really quick on this part and jump right into the nitty gritty.
Yeah, sure. Conduit is a layer zero, hardware-based layer zero protocol, starting again from the bare metal up, highly distributed, decentralized. It is a full replacement for centralized cloud services today. It is one of our value props, although we have many, but one of them is turning cost centers into profit centers. And by doing that at the infrastructure level, we are probably a 2.5 in terms of, we can facilitate and be core infrastructure for all of Web3, but we're also Web2. And, being able to move people off of Azure, AWS, Google, and the likes of them. So we're super flexible because of the layer and the stack that we focus on. And we believe that we're probably partners in some way with most projects that are out there. Again, I think we have a massive fallacy in Web3 right now, where much of the infrastructure is actually not decentralized. A lot of the validators are still running on centralized infrastructure, and so we believe in that tenet. We believe in it very much. We believe in sovereignty, and we believe that all starts at a hardware security. It all starts at a hardware level. Happy to be here, excited for this conversation, Ken.
Yeah. Well, and I think both of us come from the perspective of trying to solve a Web2 problem. Right. This isn't us trying to get adoption into Web3. That's not necessarily what we're trying to accomplish. I think, at least for us at Tashi, we looked at some Web3 tech. We said, this is incredible tech. We're going to rewrite this algorithm. We're going to optimize it for a specific use case. And then we've been taking off with it in the gaming space. And it's been pretty incredible. But our core value proposition is a Web2 value proposition. I mean, fundamentally, it's about the gamer's experience and developers saving money and all of that stuff relative to the Web2 space, and not necessarily like, hey guys, we're building a Web3 game and everybody wants to own their assets, and so everybody should jump on board and participate. Like, there are ways to accomplish that without necessarily blockchain. But what we wanted to do is understand how the technology could be used to benefit the Web2 space. So I think that's where you kind of brought up that Web 2.5 component, is that you've got customers in both the Web2 and the Web3 space. And I think fundamentally, that's kind of the way we should all be operating. We should all be operating from the perspective of like, what value are we bringing here? And is it worth it? Like, do people actually value that? Right. So Something you and I have been talking a lot about, though, is the economics around a good DePIN project. Maybe we should talk a little bit about where we are in the DePIN space today. I know you've got some numbers about annual recurring revenue in the entire DePIN space.
Yeah, I think the last statistic I saw was 11.5 million ARR across all of the DePIN projects. And yet, off the top of my head, I think if you add them all up, you're, a $6 or $7 billion in valuations across these. And I'm very confused at how anywhere. And I think a lot of other people, right, from what we might say the real world, would go, this doesn't add up.
Right.
How can you have that small of revenue and these valuations that are sitting over here? And so I think that's a great start. That first of all, I think if I was to say a positive, it's that DePIN actually does have revenue, but much of crypto has none, right? So that's a great start. But I think we have a long ways to go. And if we're talking about operating core infrastructure, which DePIN should in many different facets, there should be revenue there, because that's a real need. That's something that people are paying. Likely what you were saying is that they're already paying for it today. Yep. So your value prop has to be that we offer something greater for something you're already paying for today. And whether that's a cost reduction, whether that's a revenue generation and participation, whether it's a technical efficiency to the architecture, one of those three things, there needs to be a value prop. But I think what DePIN, the cool thing is that it's not necessarily creating something new. It's saying, how do we take something existing and do it what should be in a better construct?
Yeah, and I think you
should go with it.
Yeah, and if you take, some of the subsets, right? Let's talk about GeoNet. It's a mutual friend of ours, the whole GeoNet team. And looking at what they're doing, there are already companies doing what they're doing to improve the accuracy of GPS for all kinds of use cases, and they like to give the example of the farming use case or the automated lawnmower use case. There are already companies that are trying to do this, right? And they already have costs. Now, one of the challenges they have is how do they get more of their devices in the centralized scenario, right? So this is GeoNet's competitors, the incumbents. The question is, how do they get devices sufficiently distributed across a geographical region to add the value that they add? And in many cases, it's going to require things like easements or like finding corporate partners to host their equipment, right? There's lots of things. There's lots of just geographical challenges for them to overcome. And then you think, well, what if we were just to incentivize homeowners to just throw a device on top of their house? And now we're getting the same effect as if we were to go out and try to create those commercial partners. Except for what we're doing is we're aligning the incentives with the homeowners and the project. And I know a number of people who have multiple devices sitting on top of their house because they're like, okay, we're going to do air traffic control. We're going to do weather monitoring. We're going to do GPS improvement. There's all these projects out there where now you've got citizens who are willing to align and give up electricity and roof space or wherever they're putting these devices in exchange for some type of value that's running through that supply chain. Because that data is becoming valuable at some point, right? The ideal scenario is that somebody's paying for that data that justifies those devices sitting on top of the citizen's house and compensating for them for that. So that kind of brings us, and this is why I love DePIN in the first place. When I look at DePIN, and specifically when I look at those types of use cases where we have sensors, the kind of the IoT scenario, it's like we need that data anyway. And all we're doing is we're aligning interests between the data providers, which are people putting devices on their house, the businesses that consume that data, and the network that validates the data and validates the rewarding of those data producers. So there's like this alignment of a network of technologies. And you can think about it, in traditional business, you're going to have the customer at the very top, and the customer is going to pay some service provider. And then that service provider has to pay their vendors and their infrastructure providers. And you're going to kind of have this top-down flow of cash. In DePIN, the cool thing is it's more like you can almost think it's flipped upside down, where or maybe even just like a hub and spoke type of scenario, or maybe just a mesh net relationship where you've got the incentives aligned in a particular way where revenue comes into the network, and then the network distributes those funds according to who's participating in which roles based off the value they add into that system or into that service that's being rendered. So, and I guess the real question is how do we calculate the real business value of these DePIN networks and our own too, right? So, with Tashi, it's pretty straightforward. If we do what we think we can do based off of our projections, we're going to bring down the concurrent user cost of game developers by half, and we're going to take their network costs almost to zero, their network egress costs almost to zero. Massive value to game developers. And then we can take the savings, a percentage of that savings, and use that as the fee structure, the fee model to those developers. So they're saving money. They're getting the same benefits they were getting the day before. In some cases, they're getting better benefits. There's some value propositions we add that the Web 2 can't satisfy. And they're paying less. Fundamentally, they're paying less. But now that revenue stream comes into our network and gets distributed according to validators, orchestrators, and resource nodes who are participating. And then a percentage of it comes back into Tashi's treasury that helps operate both Tashi and also incentivize network growth. And if you think about a traditional business, you're going to have revenue, then you're going to have a whole bunch of like COGS, cost of goods sold, right? Which is going to be that infrastructure cost. You're going to have to settle that infrastructure cost. But then you're going to have marketing fees. You're going to have administrative costs, sales costs. You're going to have all these different costs that as a company you take on and that's your burden. And I would say that in this model, the treasury kind of becomes that administrative marketing ecosystem growth fund, but all of that COGS is handled by the network automatically. And if you build it right, and if we build it right, at some point we can step away from it and it just keeps churning. That engine keeps moving with or without our direct involvement in it. Now, right now in the beginning, we have to get that flywheel spinning.
Yep.
So it takes us pushing, adding energy into that with a dedicated team that's focused on doing this. We're all compensated for that accordingly. But the goal is in 18 months to 2 years that this flywheel is going now. We've got enough revenue coming in the top that the whole ecosystem is compensated for the effort they're putting back into the network, into the services. And it's all automated at that point. Like there's very little for us to do except for continue to improve the protocol, create optimizations, add new use cases, expand that revenue pool so that now people have more revenue opportunities coming into the network. So I think of it that way. It's like there's a way that traditional businesses operate. I've run many businesses and I know what it means to balance your books, and I know what it means to do taxes and reporting, and I know what it means to pay vendors. It's like a dream to be able to say, hey, there's a set of services that kind of auto manages itself. And I know that I'm always going to get the best service. I'm always going to get the best price. And it's really hard for centralized organizations to compete with that because the incentives are different. As an organization, I have the incentive to satisfy my shareholders, or in some cases myself if it comes to bonuses, right? Or share value, right? So I'm trying to increase the margins as much as possible. In this other model, the incentives are very different. The incentives have to do with aligning the resource costs, ensuring that those are covered and that people are appropriately compensated, but also figuring out all the other parts of the ecosystem that need to get aligned. And I think you have a slightly different way of thinking about this, right? You call it mutualized value. And so I want you to kind of talk a little bit about what mutualized value means. Because I think I'm saying that, but not using the word mutualized value, right?
Probably. So there's a couple things that before we go there, I wanted to go back on. We talk about like GeoNet and some of these others. Those plans have actually been in place and been done many different ways. Like go back to utility with PPAs, with power purchase agreements. They were putting up the solar panels on your house, right? So you got to do that and you got paid for that in a share of revenue of what was generated. But they needed your roof, which was a latent asset, unused space. Let me put this here and we'll share in it, right? So like the concept of this isn't necessarily new, but they're very powerful. They have worked. When you can align people to an outcome, you can move vast industries of people to do things. And then the other thing that I would say is, for me, I have a different opinion of what I believe Bitcoin proved than I think most people. And to me, it didn't have to do with an alternative currency or this highly, secure structured store of value. What was interesting to me was that if humans play game theory, and they will figure out how to play that game. And if you set the rules accordingly, they will play those rules, and they'll also try to figure out how to game the same game, right? What was interesting to me on Bitcoin was that because they set the rules from the beginning algorithmically, you knew how to play the game. What they got people to do was to invest billions and billions of dollars and build the network themselves. Something that if you were to do that corporately would have taken an immense amount of time and probably actually not got there to the scale that they did. And all they really did was set the game theory up front, align incentives in that way, and look at the infrastructure, if you want to look at it that way, in terms of mining, that was built by people, not by companies. And eventually we got to, publicly traded mining orgs, but that took some time. And so just look at that as a use case of what you did when you set up a game theory that people could play, that they knew. Here's the key. They're willing to put investment in time, effort, and money if they know the rules of the game won't get changed. Do the rules of the game get changed corporately?
Yeah,
all the time.
Yeah,
all the time. They're moving. They're
every quarter we're re-announcing something, right? Because you have your
constantly
quarterly reports, and people are going, okay, what's changing? I mean, just look at Unity, right? Unity just changed their entire business model this last week for the better, might I add. But
and
it's
sometimes it is. I'm not going to say it's all bad.
Well, it was for the worse last year. And then this year there was a correction. So, but you're right. I mean, the point being is we don't know the rules of playing with Unity right now. So as a Unity developer, there's a certain amount of uncertainty as a developer. And the question is, how much effort and time do I want to invest in Unity, given the history for the last year where the rules have changed 3 times on their business model? It changed very drastically one point. Everybody freaked out. It changed again. People were still pissed off. And now it changed once again to kind of try to back out of what they had done last year. So 3 times in 1 year, Unity's entire business model's changed.
Well, and look at how it changes from private to public. Look at how it changes through a merger and acquisition. Look at how it changes when a private equity goes and rolls it up. And now they have different incentives, right? They have different alignments than what you originally had. Same thing, again, private to public. There's all these nuances that ends up changing the game. And so one of the fascinating things in these business models is that if you can get to a place in which at least the basic rules do not change, they're algorithmically driven, everyone knows what the rules are, and we're all deciding to then go play. That's the start. If you can get that, then you can get people to invest their own time and money, knowing that the rules aren't going to be changed here in the future for what they thought they were getting into. That's super important. And I think to me, that's what Bitcoin originally proved in this whole space, was that I watched what was built under those rules that people trusted they weren't going to get changed. Okay, then I know how to play this game, and I'm going to go play it. When we talk about mutualization, there's a lot of different facets to this, obviously. And we've talked about the Rolls-Royce example. If you go to not all, but a lot of the major corporations, when they look at supply chains, they're looking at it for 2 different vectors. First of all, is supply chain risk. So the reason, as an example, Apple wanted to go purchase and roll up all of their supply chain is to mitigate vendor risk and supply chain risk, to manage it and control it, which could be huge impacts to their company, which is now worth, over $1 trillion. The other thing that they were able to do is this alignment in their supply chain. So no longer did you have, in this scenario, and Rolls-Royce did the same thing, and there's lots of other companies, this isn't necessarily new, is that if you control that, You don't have each individual that, again, is playing their own game with their own rules, trying to put a moat around, let's say, their balance sheet and income statement. They're aligned to an outcome, and the outcome's over here. And if you can get that, you drive immense efficiency across the entire production, which means you get immense value creation.
Well, and let's make sure that we call out maybe some things to be aware of. Like Apple acquired their supply chain.
Yep.
So it's all controlled centrally.
Yep.
So that's why there's alignment. That's one way to get alignment, is just to buy everything and own it, right? Rolls-Royce coordinated with their supply chain.
Yep.
And we're able to get alignment. And that's still a little bit different.
It's different, but it's closer.
It's closer, but it's a little bit.
You have autonomous orgs that are choosing to align to an outcome. But the only reason they chose was because Rolls-Royce said, we're going to have you share in the profits at the end results.
Right.
That's the mutualization and incentivization. They said, we will do this. So if you can all figure out all of your inefficiencies, if you can all figure out how to work together in a way that you've never worked because now you're aligned to the outcome.
That's right.
Then we'll let you share in that. Well, everyone went, great. Now I don't have to sit here and self-protect, self-project, and figure out how I get my profit margin before I hand it to the next person because no one else is helping me, right? I have to protect.
Well, and I think, the interesting thing there is that Rolls-Royce was able to do that because they owned the customer relationship and they were willing to incentivize their supply chain in that way. And that's the challenge, I think, with most Web 2 companies, or I'm saying Web 2, but most centrally structured, organized companies, is that somebody owns that customer relationship and they get to kind of decide how they're going to share the opportunity. Because I agree. I think anytime someone says, hey, I want to partner with you, and by the way, there's obviously some costs up front we got to cover, but let's put the majority of my compensation relative to the success of your sales. Like to me, that always gets exciting when I'm working with the project. As a matter of fact, LaunchBadge, which was my engineering company I started in Sacramento, our initial model, it's called LaunchBadge because we gave people a merit badge once they successfully launched their product. And so we called it LaunchBadge. It's a little rocket on a merit badge that we'd give them. But our first few customers were like, hey, listen, we're going to basically give this to you at cost plus 20%. And we want 2% of the revenue on the end, right? So we had a 2% rev share for the first project we went to. We turned around and 10x their revenue. And then we kind of like lived off that 2% for a few years because that's how long the agreement was. But it was one of those things of like, we wanted them to be successful. We wanted them to be as efficient as possible. We were basically rebuilding their entire product that they were selling. We were like, how quickly can we do it? How efficient can we make it? How beneficial can we make it to their customers so they get more customers that they can manage with fewer employees? So for us, I get exactly what you're saying is like when we were able to make that agreement, we were aligning LaunchBadge's interests with our customers' interests. And the outcome was better because it allowed us to have a bit of a buffer and do other fun things as LaunchBadge. Even though we didn't have active customers paying us at the time, we still had revenue coming in. And so, and we were also incentivized to go back and make sure they were continuing to be successful. As long as that incentive was there, we were like, listen, is there any support you need? Can we make this even more efficient? How do we get you more customers? But to your point, if you've got the person who's making widget A that plugs into widget B that now makes this product C that you're selling, it's like, how efficient can we make widget A and B, bring down the cost so the margins go up? If they both know, widgets A and B know, companies A and B know that they're going to benefit on the back end of that efficiency, as opposed to them trying to squeeze every ounce of margin out in the beginning.
That's correct. So the alignment is extremely important, and setting the rules. Let's think about this algorithmically, right? Mm-hmm. Setting the rules in which all participants are playing the same thing. Now you have a second thing that you need to do. How do you mutualize the value?
So what do you mean by that?
So if you have companies that are operating, they don't have any other than the profit on the end result. There's not another interconnection of mutualized value between them. They have their own balance sheets, they have their own bank accounts, they have very separate. Okay, this to me is what tokens should be for. Is that you have a mutualization where all of the revenue and income is going to the network in which you are all participants in by way of the token. All of that gets pooled. Think of it like a pool, like a private equity firm that has 40 companies under them. All of it gets pooled, then distributed back out into the token, in which is the same token that everyone is acquiring and using on the network. That's the mutualization of the collective value. And what happens there is when you align incentives, like we talked about, you give the actual tool, which is the token, to prove the alignment, and it's algorithmically proven, so we know what the rules are played, that we're all participating in. Okay, there's a couple things that end up getting driven out of there. First and foremost, you have a new paradigm which your competitors are no longer your competitors.
Right.
Why? Because if they're increasing the value that's coming into the network, I'm also at some proportion seeing that in the realization of the same mechanism of the token that I hold, because the value is going into all tokens.
Right.
So no longer am I looking at this going like, I need you in our current system. Typically, when we talk about taking market share, you're taking it from who? Someone else.
Yeah, your competitor. Yeah.
It has to be shifted somewhere, right? Now, there are specific times and places that we have value, new industries created. Okay, great. That's fine. That's a new evolution and a new, but most of the time, that is not the case. You are competing. If you could get people more focused in their energy and not creating moats and self-preservation, but focused on how do we actually drive efficiencies across. And in fact, even though you are a competitor to me, I actually am literally incentivized to help you, because if you grow the network, I win too.
Well, okay. So a few things have popped up that you've been talking about. First one, in the token model we've talked about, at least for us, when we look at the DePIN layer, we've got the DePIN architecture, the structure of our network. This is our decentralized physical infrastructure network that all operates in what we call eTashi, which is effectively a stable coin, right? When developers pay $1 at the top, there's $1 to be divided in the network. A percentage of that is going to go to the orchestration layer, to the validators, a percentage of that's going to go to the resource nodes, and a percentage of that is actually going to go into a treasury. Now, we have the ability to swap eTashi for Tashi. Tashi is a Tashi protocol issued or a treasury issued token that is a speculative token separate from eTashi, which is a strictly network utility token. And Tashi is used initially to kind of like bootstrap the network, to reward early adopters to get sufficient resources on the network. It's also a governance mechanism. So there's the rewards mechanism, there's a governance mechanism. But if people want to speculate on Tashi, they're welcome to. And the cool thing is if you're receiving eTashi as a resource, you can automatically swap over to Tashi if you just don't want to deal with the stablecoin side and you want to have some fun.
Yep.
Or if you don't care about speculation at all and you just want to cash out, you're cashing out your USD value back to your account. And so we've created kind of these two mechanisms, and this one kind of helps seed the network, the DePIN side. So the treasury side helps to seed and incentivize the treasury or the DePIN side. And the theory is that, we've got a certain number of months on the treasury side that we can help push real revenues on the DePIN side. And at some point, the revenues will become sufficient enough to sustain the entire DePIN network without the treasury anymore. Now, that being said, there's still going to be eTashi going to the treasury, which means it's going to keep the marketing going. It's going to keep all the things you would normally have budgeted for marketing and ecosystem growth is going to continue to grow. Building out new use cases and verticals, that's all still going to be there. But the point being is that the way we see the Tashi side of it is this is how we get the flywheel spinning. And once the flywheel's spinning and revenue's coming in, it's less important to keep the flywheel spinning because now it's spinning on its own with revenues that are coming from the top. And I think, and I bring this up because you talked about bringing in the value of tokens. Well, if everything is in eTashi and Tashi, there's this ecosystem of Tashi and eTashi. US dollars are coming in. They're staying in the ecosystem. The question is, how long can we keep those dollars, that dollar value in the ecosystem, right? Because as soon as it leaves the ecosystem shrinks, right? And this is something that we've talked about. And I think this kind of goes to a little bit about what you're talking about, even potentially investing in your competitors, right? Because we all win when the total value in the ecosystem grows versus when people are cashing out frequently. And so now we support that because people have to pay their bills in USD sometimes. And I think there's some cool things that, Conduit's working on that Tashi's probably going to play a role in that could make less leaky. but but that's the way that we're looking at this, right? We're looking at how do we get this flywheel spinning? We're using the treasury to get the flywheel spinning, and now the treasury is used more for ecosystem growth, new verticals, new use cases to get new flywheel spinning that grows the entire ecosystem. So it really is like you can think of it as a starter in an engine, right? Is the treasury. But once the engine's running, that motor's going. You got fuel coming into it, which is the USD value. You've got it combusting in the engine, which is the orchestrators and the resources and the validators. So the combustion's happening. And as a matter of fact, a percentage of it is going through the generator to recharge the battery so the starter can start the next thing, right? So it's kind of this cool parallel with how an engine would work, of how we're using these two mechanisms to create this flywheel, that the goal being, and I think you mentioned this earlier, that the DePIN layer is self-sustaining. It's got a revenue that's coming in that it no longer needs the starter to support it. Like, we don't want our engine turning constantly. We want it to be able to start right up, and then it's running, and then it just runs as long as there's fuel coming into it, which the ideal scenario is that we've got a multi-billion-dollar fuel source called the game development industry, right? And so our view is like, okay, what is our total addressable market? That's how much fuel we think we have to run this engine called DePIN. And then as we start to build out the resources to where we're not getting enough utilization, say the growth of our resource layer outpaces the growth of the demand, right? Demand from developers. Developers are paying $10 billion a year USD into the DePIN layer. And we've got, we'll say, millions of resource nodes, or potentially tens of millions of resource nodes. We've outpaced it. Everybody's getting little bits and pieces, but nobody's getting huge chunks anymore because it's so saturated with resources. Well, what better reason to go build out the next vertical where we're increasing demand again through a new vertical? And so that's the way we're thinking about it, is because our technology, while we built it for gaming and we're using gaming as the de-risking mechanism, the long-term vision is like, no, this is way more useful for things outside of gaming. Yeah. And we already have our eye on a few different verticals where this could be useful, where these resource nodes that are currently going to be supporting the gaming use case in the DePIN could also be used for other use cases that would grow the total ecosystem value. Now, that all being said, okay, so I'm talking, and I'm just making sure that we're in alignment about, like, what are we talking about growing this economy, if you will, this DePIN economy? Mm-hmm. Now, here's the thing. I've got eTashi and Tashi, right? Those are my two coins that I'm using. You've got a few different things and a rewards point that you guys are using.
Which, by the way, and just to make a correlative, our rewards point is very similar to your eTashi. It will look like a stable coin. So just so you know, there's similarities with what you already have in terms of our two assets, our two digital assets, and same with yours.
Yeah. So, well, let's talk about that real quick, because like there's a clear technical alignment and even like kind of an ethos alignment between Tashi and Conduit, right? There's some good real reasons why we would work together. You guys handle a bunch of problems we need to have handled at the hardware level, and then we can support a bunch of application layer stuff on the software level up above, right? Yep. So there's some clear things that we can work together. Now, the question that I'm sure a lot of people are asking is, okay, I've got Tashi and eTashi sitting here capturing value for the Tashi ecosystem. How does Conduit benefit from that? Or how do we mutually benefit from the Conduit and the reward points versus eTashi and the Tashi points, tokens? So if we've got Conduit devices running that have Tashi software running on them, there's still a technical barrier there, meaning that people will have to pay for both the Conduit machines and the Tashi resources. Mm-hmm. What is the mechanism for us mutualizing that value across our ecosystem? So it's not just like the Tashi economy and the conduit economy, how do we create the DePIN economy? I'm going to drop that grenade. And I don't know how far you want to go down that route. I mean, if you want, just say, we've talked about this, we've got some plans, we'll talk about it later. That's fine. But I want to get people thinking about what you said earlier, because you were saying that like potentially we're investing in our competitors because we want them to succeed because it grows the whole ecosystem, the whole economy. But I want to.
So
Steve was saying a tack-on token. It's conduit Tashi conduit tack-on. Another token. Is that the answer?
No, I don't think so.
I don't think so
I don't. Because the reason that I would say this, there's two different ways, and I'm trying to figure out the easy one that I would say right now is without being in a highly connected network in terms of economics, you're not going to necessarily align incentives, although you could move value, which may be okay as an intermediary. So like one of the things that we've been working on for a while is tokenization on demand.
Mm-hmm.
Okay. Which means that like without any of the ways that we tokenize today, you would be moving, think of this like a corporate balance sheet to balance sheet transfer.
Yep.
So you would be moving value across the two networks. That's like at the surface, a very easy thing to do with different ecosystems. Now, I would say like what we've talked about, and I don't know how, deep we want to go, or even how really that we've gone just yet. And so it's like, this is conceptualization, right? What you just laid out here is that we both have two technologies that are mutually valuable to one another, therefore mutually valuable to each ecosystem. And so there's not a reason that even if you just did the layer of tokenization on demand, that people couldn't be moving in and out of those two. And the reason that I would say that is that if we talked about, Tashi nodes running on Conduit, that individual is going to be producing both digital assets. They're actually sitting in both ecosystems already.
Yep.
And we believe that like by virtue of that, people should have control over where they want to move value in and out of too. Of course, we want to set up, and we have mechanisms to be like, the biggest detractor to GDP growth is economic loss, meaning it leaving, right?
Right.
What you lose in that point is the strongest law of finance, which is compounding. You don't get a compounding effect inside of an economy and growth when things are going out. So you want to try, not necessarily from a moat perspective, you want to do it through an incentivization. Like you are incentivized to stay in here because of these three things. It could, likely it could be value transfer and value loss when you're going in and out of different systems. And the other one is you're losing compounding. Mm-hmm. And so what you want to go look at is like, okay, what is going to provide me the most amount of value in terms of the ecosystem that I'm operating in? The mechanism that we've done, which I don't know how exactly it's going to play out. We have our network utility token, which needs to be done for all settlement, is CNT. But our other side is the rewards. And that is a one-to-one based off of crop contribution. Just think of crop contribution as your proof of economic activity, and it's really your revenue. Mm-hmm. Okay. In the future, let me go out of token world for a second and go back into real world, right? Some of the largest economies in the world are reward systems. And so in the future, we are going to connect through reward aggregators, the conduit reward, which means you will be able to take the conduit reward that you are getting there and go spend it at Marriott and go spend it at airlines.
Let's make sure that we're capturing the concepts here appropriately. Okay. So you talked about economic growth, GDP, and we've talked about, preventing loss or leakage of that value outside of the economy is one way. So you want to keep value in the economy. And I think you mentioned this, but I want to just like really zoom in on it, is like the most valuable way to create growth in an economy is with turns. Can you explain what a turn is first? And then we'll kind of like, I think that leads right into like the rewards model, right?
Yeah. So there's only two ways to grow GDP. It's net new activity. So new people coming in or something being created. And the second one is turns. And the turns are the easiest way to describe turns is that you, me, and one other people are who's in the economy. I have $1 and I spend it at Ken. And then Ken spends it at the third person. That's 3 turns. Okay, to increase GDP, you want a 4th or a 5th or a 6th, because what's the value of that $1? It was only $1 that circulated 4 to 5 times. There's your GDP growth. So turns is places to spend inside of a given ecosystem. This is why reward systems are so powerful. Is because
and so let's ask the straightforward question. I remember talking about Bitcoin with my buddy Nick a few years ago, and him going, "Cool, where can I spend my Bitcoin?" And that's been the question for 15 years.
Yep.
Like any cryptocurrency project, any crypto project, the question is, cool, where can I spend it?
Yep.
And I think it's becoming more useful. If you go to a conference, everybody takes crypto. There's plenty of things to spend crypto on in the digital space. We can do that in the gaming space. We can do it with NFTs. We can do it with meme coins. Meme coins is weird, but that's an anomaly in itself. But the argument is like, there are places to spend your crypto only within the crypto ecosystem. So there's no like real world value. Although I would argue like Newegg, I love what Newegg does because I can go and buy all my computer parts and stuff through Newegg using Ether, which is cool. But that's kind of the unicorn, right? There's not a lot of that going on. So let me ask you, why hasn't the rest of the ecosystem, why hasn't the rest of crypto succeeded in that, being able to create turns in the ecosystem that result in real world purchase value?
I think one of I think there's multifaceted, first of all, but I think one of the things is that not everything in the world needs to run on a blockchain. In fact,
absolutely.
A lot of things, right? So by the nature of the technology, you've already limited. If we think of like the bulk of the value in the world sits in supply chains and value chains. Okay. So if we think about this in terms of economies, what we need to be going after is the value. Well, a whole bunch of that value can't actually come onto this system. It doesn't serve its purpose, right? So you have it sitting out there, and this being already, you have a disconnect between the two in terms of technological. The second thing is that we haven't gotten to a place in which, and everyone's talked about this, where the interfaces and the usability are easy.
Why not?
I think there's a whole lot. I mean, opinion-wise, I think
like
that
BitPays is not that complicated, right? It's fairly easy to use. But to your point, like I still got to go through a KYC.
Correct.
Like it's not as easy as it should be. Like I can't just like.
Okay, so let me tell you
my portable KYC with me into a new wallet.
The third component here is where I think we have lack of regulations. Okay. And so you have an adoption stifling because of regulations. And the biggest reason why that is the truth is because crypto has been notoriously synonymous with currency.
Yep.
And I am telling you right now that governments and countries, if there's one thing you don't want to attack, that they don't want to give up, that is currency control. Now I understand why, and I understand why we went after it. I'm just saying, like, that is that is the thing that they hold on to, right? Is control of currency. So you went after the hardest thing, and I'm not surprised we're 15 years later. In fact, I could see this being a 50-year type of actual evolution, because that is like the thing. So in order for you to actually get them there, you have to get them into it. They will not allow this two-world concept to exist. Yep. It just won't happen. So they've got to come in at some, and I don't know how that looks, so I'm not going to go into that, but I think this is part of the issue that we have with this. Now I'm going to pose something different, and why we went down this rabbit trail, and why we created a reward system.
I wanted to set all that up. So this is, yes. Continue with the reward system.
Is because that is adopted already today inside of the current systems at billions and billions and billions of dollars. In fact, the reward systems bolster some of the largest corporate balance sheets in the world. So it's accepted. Also, because of the value that is created in those and how valuable they are, you have some of the largest lobbying groups here in the United States. I'm going to speak to the United States, lobbying on Cap Hill for those to be protected because of what they do for the corporations.
That's right.
So instead of, my proposition here is, instead of running in with picks and shovels to take down the whole thing, why don't you play into an already regulated, authorized, and protected shell which exists? It's not a value issue because there's massive value in the reward systems.
Well, and especially if you integrate with the existing reward systems.
Oh, that's a whole, which is actually relatively easy to do. There are large scale aggregators of rewards points that do all of the balance sheet transfers for this, right? Do you lose? Of course you do, because there's a middle, like all of that. And I think we have an ability, okay, on our side, because part of what our technology is supposed to do across all of Web3 is removing middlemen. Are we in agreement?
Yep.
Okay.
Disintermediating. Yes, that's the.
Sure. Yeah. So why don't we take the shell of a construct that is accepted and apply the efficiency of disintermediating, okay, to drive, which is the value of capital is simply equated to the velocity of capital. Turns. You want capital turning and moving, right?
And not leaving, not leaking.
Yeah. Correct. So what you do in a reward system, they already do it today, is that they disincentivize you leaving. Meaning two things happen. You want to take it out, you're going to get quote unquote taxed. People don't think of it like a tax, but the reward system, you know, if it was
there's a premium.
Absolutely there is. And they set the premium because they're trying to keep it inside for the same reason. Okay. They're trying to give you value, which you can spend, but they say, look, you need to spend inside of our network, but you can take it out. The other thing is that if you don't take it back to cash, is it taxed?
No, I've never been taxed on my rewards. I spend rewards on flights and hotels all the time. Now, granted, the hotel gets taxed on it when they cash out.
So let me propose something, Ken. We all have this tax issue and this concept inside of crypto and everything else because it's a crypto
currency. Yeah.
What if it was a reward? It was just a digital reward that was moved throughout ledgers, just like they do today, and we're fitting inside of the existing framework. Now, you can't do that necessarily with a variable asset, which is why our utility token is a variable asset. That's going to be in a whole nother category, but we have a secondary asset, which is the
reward.
Correct. And if you really look at this, the one that is going to be like fast forward 10, 15 years, the thing that is going to be of the most amount of value, the reward.
Well, okay. So I'm going to call out the elephant in the room here. Because if this gets traction, Capitol Hill is going to take notice, right? Regulators are going to take notice. Now, granted, reward systems already exist, right? Reward mechanisms are already multi-billions of dollars.
Yes.
Yeah. So I don't know how big we have to get before it gets anybody's attention. But do you see that as a risk? Do you see that as them like reclassifying tokens and saying like, listen, you can't call them rewards because you've been calling them currencies for the last 15 years? Yeah.
And so two things. You can't just call it a reward because you want to evade a classification. And you need to show that it literally, like mechanically exists the exact same way of what happens over here. Okay.
And that's where the accounting comes in, right? That's where the USD accounting comes in, right? Because when you take in USD, you're playing the same reward game. You're going, all right, that chunk's coming over here into rewards. Oh yeah, this thing over here that is our token and that is driving our treasury. Like, okay, call that whatever you want, regulators. That's not our reward system. This right here is our reward system that is very cleanly taken from revenue USD and allocated into a reward system that follows all of the same patterns that other reward systems follow.
To a T. Okay. Yeah. So at least you should be able to pass the, if it walks like a duck, talks like a duck, it's a duck, right?
Yeah.
And so what we're betting on there is like, look, if you want to recategorize us, then you have to recategorize every other reward system here.
Yep.
So like by virtue of that, we've put the existing regulations as a moat around us for that portion. Okay. Are they going to come after it? I wouldn't be surprised, but I think there has to be quite a bit of velocity, because the other thing is that now what I'm proposing, Ken, is it's not us and the crazy crypto Web3 people that are going after Capitol Hill. You'd have every major corporation standing beside you going, you're not going to touch our reward system. That, like, I give this example and I'll say it again. American Airlines is worth 10 billion. The reward system's worth 35 billion. They're not like, you could go down the list of corporations, and this is something that they are absolutely going to protect. The other interesting thing that, so I don't know, I can't predict the future on regulations, but I feel that we have a better moat and better runway than what we do with a currency.
Yep.
That's what I'm proposing, right?
Well, and you know, I talk to regulators all the time. I went last week to a cool little conference here in Sacramento that was all about consumer protections, right, and cryptocurrencies and stuff. And I'm talking to the regulators themselves and the attorneys that are like representing either the crypto companies or regulated agencies, and so a regulator agency. So I'm talking to these companies. I think everybody wants this solution. Everybody wants. There's nobody out there saying we want to kill this innovation because we're trying to protect something. What they're trying to say is I don't know that there's enough collusion or even capacity to collude in the government to really be scared about the currency part of this, but they're using it as a soundbite.
Yep.
It's really the consumer protection part, right? Their concern is, how do we protect the consumer? Volatile assets means that consumers are easily taken advantage of. Plus, there's just straight up scams and frauds out there, right?
Absolutely.
That's what they want to protect. So I think when we take a lot of that opportunity off the table, like when we have Itachi, which is like basically our stable coin, right? It's a business. We can account for it. We can show its growth and loss in USD. There's no question about the value of Itachi. For your rewards, similarly, it's a percentage of total value that comes into the system, or a percentage of the economic growth of your system. You can denominate it in USD just like you would any reward system, and you can show the accounting for it, and we can defend it as an accountable item. And I think regulators are looking for these. Like, I don't think it's like, oh my goodness, it's a token, we need to regulate it. I think they're looking for people to take the lead and show how this actually works. Because I'm talking to these people. I actually have one DFPI, the Department of Financial Protections and Innovation in California, which was set up specifically to deal with cryptocurrencies, are asking me to come in and consult with them and help them navigate the technologies. And I'm sitting there going like, okay, what is it you guys are trying to protect against? And we're having these very real conversations. I think a lot of what you're discussing or describing is exactly what they want to hear. This is the direction that they want, because they don't know this space. You know, we're asking for regulatory guidance, and they're coming in and saying, well, show us what a healthy technology should look like, what a healthy economy should look like. And nobody's really done that yet. There's nobody in the space that has really taken the leadership in showing what that healthy ecosystem looks like. Now, okay, so
wait, take it one step further.
Okay.
Because it's not just economic design that they can get their arms around. To your point, it's protection, which goes down to, provability. Yep. And the reality is that blockchains and immutable ledgers are not accounting systems. That's one of the reasons that we built one of the first DLT accounting systems.
So what do you mean by that? You're talking in traditional term accounting, where we've got double entry accounting that's been around since what, the 1400s, 1500s? Like that style of accounting. What CPAs all go to school and learn and pay big bucks to get.
What the regulators actually go when they go to like figure out what's going on, they go to that. They go into your books, right? And they start tracking the money and the accounting. So what in designing all this, we're like, okay, this is all great in mechanics, but if you don't have a ledger that is able to do what we look at is in terms of corporate accounting, because you're going to have corporations, you're going to have businesses, you're going to have commerce, all of that needs to happen. So the ledger needs to expand from just a immutable ledger into an actual, what we call synchronized accounting ledger, which allows you to operate like a ledger, right? Here's what we ended up getting to, which is the fun part. And I'm getting back to regulators in a second here, which is what we proved through this technology is that you could have point in time audited financials. That's never been done, ever. And we had it fully audited by KPMG.
You know what's hilarious is like the amount of work I go through to unwind my crypto activity to pay taxes every year. I paid $12,000 last year to have my CPA unwind my business crypto. Right? Why is this accounting? Why is this public ledger that's supposed to be so easy to use so expensive for my CPA to make sense of for tax purposes? And by the way, my CPA is incredible. Saved me tens of thousands of dollars last year in taxes for my businesses. But it's one of those things of like, why did it cost $12,000 to have my CPA unwind my crypto? Why can't he just hit a button? Why isn't there a convenience component to blockchain or distributed ledger?
Now you can, because that's what we were frustrated at. So, and I'm backing into the regulators to say this. If you have a system like that is able to run full audits of commerce, of your rewards network, of everything, and doing it in a highly effective and efficient manner, what you're doing is that you can provide them with the proofs, which is all that they really want. And what you're actually allowing them to do is to do their job exponentially better with lower friction, which means this it isn't about how do I get my arms around this to protect. It's you've actually literally just allowed me to do my job increasingly better, which means I like new standards are going to be created out of this, right? That's what's going to happen. And you get the regulators on your side going, this is actually a great step forward for all of us, for everyone involved, because now you've solved the piece of having to take things from on ledgers into actual accounting. And it's a mess, like you just said. It's an absolute mess. Why don't you just build the ledger in a temporal database to be able to be a fully double accounting ledger across and all the subledgers, that everything rolls up and you have an accountability for everything that occurs. And now go get it.
So a few things have come up during this call, and I think we need to do another stream like this to continue this conversation. And maybe we need to watch this stream the hour before we start the next stream, because we got a 2-minute hard stop on Twitter. Twitter will kill the call if we don't like schedule it out. So, but the few things I hear, like the first thing is, the goal of this mutualized value is alignment across the supply chain, across the value chain. We'll say the value chain because the value chain includes up, down, and around, right? So we've got alignment across the value chain. The next thing is a lot of what we're doing is not new. Like double entry in accounting is not new, right? Reward systems aren't new. These are all like even some of the stuff we're doing on the technology level from a gaming infrastructure perspective. These aren't new models that we're making. What we're doing is we're taking better technologies and implementing old models that work, that have been proven for hundreds of years, and making them significantly more efficient. Like we're not coming into the space going, here's a new way to do stuff. Here's new technology.
You're changing the outcome.
There we go. Yes.
That's what you're driving efficiency and changing how this is how the car's put together. And by virtue of that, the outcome should be higher value, right?
Yes.
But that's what you're ultimately doing instead of saying, let's break everything. Let's redo all the things because we're trying to get to a new outcome. What we should be doing is going like, hang on, there's some things that actually structurally work. If we applied the same model in a different fashion, do we get a different outcome?
Yep.
And if the answer is yes, then that's really good innovation. And then you can get the old, let's say the regulators are of old, to come in and go, oh, I know what you're doing. I got this. I know these models.
And we've just made it more efficient. So awesome. Well, we're going to end here. LinkedIn and YouTube are still going. Twitter has died. So goodbye, Twitter. But let's go ahead and continue this conversation. If you're available next week, I'd be happy to continue
Let's
this
do it.
next week. But absolutely, I think for the next call, let's really dive into how do we participate in that ecosystem together. Let's have that discussion a little bit more. And what does potentially growing like what does adding turns look like once we've grown this ecosystem? Like what are some ways we add turns and raise the tide for everyone, right? So I think those are 2 points we can jump real easily into, and we don't need to rehash everything that we went through this time. So anyway, thank you again, Brandon, for jumping on. We got plenty more to talk about. Everyone, thanks for joining us. Always a pleasure. Catch us next week, same time. We're here noon Pacific every Tuesday, unless I specifically say otherwise. But we'll see you next week. And Brandon, where can we find information about Conduit?
Yeah, Twitter, Conduit Network. That's probably our hottest place. Website cndt.io. And Ken, thank you for having us. Like these are the fun conversations, and we super enjoy it. And we'll have more announcements next week on the continuation and partnership between Tashi and Conduit as well, which I think we're all very excited about. So
only the people on YouTube and LinkedIn just heard that.
Yeah, I know.
It's wild.
There'll be announcements coming, but we're super excited to align people that are thinking the same way, trying to solve the same problems and get to the same outcomes.
That's right. Awesome.
All right,
Thank
brother.
you so much. And everybody, you can find us at tashi.gg, also TashiGG official on Twitter, and look forward to interacting with everybody there. Cheers.